Mutual funds, index funds, and ETFs. You may have heard all of these terms being used interchangeably. Although they are all forms of investments, they are not the same thing. In this video, I'm going to break down what makes them different, and I have a feeling that you'll be shocked about what it is. Let's go. Hey, this is Carlos with Influential Finance, and on this channel, I make weekly videos to help you improve your personal finances. So if you're new here, consider subscribing. Well, let's jump right into it. What is a mutual fund? A mutual fund is a professionally managed investment fund open to investors and individuals. These funds are operated by professional fund managers that allocate the funds into a variety of investments such as stocks, bonds, and other assets. Mutual funds are a popular option because they offer low management fees despite being professionally managed. Fees for mutual funds tend to be around 1 to 3% of your total investment balance, although you can find many funds for a lot less. This is really attractive due to some of the advantages that they offer, which we will talk about later on in this video. A share of a mutual fund can represent many different stocks and securities, which is a simple way to diversify your investments. Unfortunately, voting rights are not passed on to the participants of the fund and instead remain with the fund manager. Mutual funds are by far the most popular investment in employer-sponsored retirement plans, such as your 401k or your 403b. This is primarily due to the low fees and because there is almost no work required to maintain the investment on your part. The term mutual fund serves as an umbrella term for a variety of different investment funds, including equity funds, index funds, and money market funds. Mutual funds are typically categorized by their investment type, objective, and target return rate. Equity funds are the most popular type of mutual fund, and as their name suggests, their primary investments are equities, or in other words, stocks. Equity funds are typically established around a certain group of stocks, whether that be based on the industry of the company, the size of the company, for example, small cap, mid cap, and large cap companies, and growth opportunities for the company. These funds carry different levels of risk, so individuals can choose the level of risk exposure that they are willing to take on. These different categories of mutual funds allow investors to pick and choose where they would like to invest their money while still harnessing the benefits of a mutual fund. Despite the many different names, mutual funds offer similar advantages and disadvantages compared to other financial instruments. Let's go over some of the advantages of mutual funds. First, they have low fees or expense ratios. Although some funds may be on the expensive side, it is easy to find funds with very low fees. Second, you get instant diversification, since a single share represents an entire portfolio. Third, funds are divided into categories based on the investment types that they make. So it is very easy to get an understanding of what you are investing in just by looking at the category of the mutual fund. And the last advantage that we will cover is that mutual funds are practically hands-free investing. Mutual funds require very little to no interaction after you invest. Let's briefly talk about some of the disadvantages of mutual funds. First, investors do not get any kind of voting rights. I honestly wouldn't even consider this a true disadvantage because most people don't even participate when it comes to submitting their votes as a shareholder. Second, you have no control over the investments or portfolio choices. And lastly, growth tends to be slower but steady. You may not see the same growth as you would investing in a single stock, but the lower risk certainly makes up for this. Hey, are you enjoying this video? If you are, can you please hit the like button and subscribe for more weekly videos just like this one. All right, let's get back to the video. Now that we've covered mutual funds, let's talk about index funds. Index funds are a type of mutual fund that primarily focuses on mirroring certain stock market indices. Warren Buffett actually credits index funds as the primary source of his wealth accumulation and has constantly promoted their use throughout the years. The idea behind index funds is quite simple. Money managers essentially mirror a chosen index like the S&P 500 or the Russell 2000. If you want to learn more about stock market indices, check out this video right here. So rather than trying to beat the market, investors can simply take advantage of the steady growth it has to offer by matching the stock market returns. Contrary to other funds that require research and in-depth management from their managers, index funds are relatively simple to manage. This simplicity comes from the fact that the portfolio simply consists of whatever stock is included in the index that it follows. Because there is minimal upkeep required, Fees and expense ratios are some of the lowest you will get from any type of mutual fund. And since indices like the S&P 500 have grown an average of about 9% over the last several decades, index funds offer a relatively safe investment choice. Let's now talk about exchange-traded funds, or ETFs. Exchange-traded funds, or ETFs, are quite similar to mutual funds as they employ similar strategies, but are classified as investment trusts and can be purchased and sold like regular stocks. The majority of ETFs are also passively managed because they tend to focus on certain stocks and stock market indices. This allows for even lower expense ratios, which means that they offer even lower fees than regular mutual funds. So the main feature that makes ETFs different is that they are traded like regular stocks. With mutual funds, you typically have to wait until the end of the trading day for your orders to be filled. This is because the value to invest in a mutual fund is typically not updated in real time like you see with regular stocks. However, with an ETF, the price of the shares are adjusted in real time like you see with any other stocks, and you can buy and sell an ETF throughout the day. Now, why someone would want to buy and sell a fund throughout the day, I don't know, but I just wanted to make sure that you knew this key difference. So you may be wondering, what's the best option? Mutual funds offer a lot of great advantages when compared to other financial tools, but they can be a little bit more difficult to get into compared to ETFs. Mutual funds require investors to purchase directly from the fund. ETFs, on the other hand, are actively traded on the market and can be bought and sold during market hours. They are also passively managed, which means that the fees are much lower compared to other actively managed mutual funds. Both mutual funds and ETFs can be excellent investment tools to grow your money and create a better future. Each one offers its own benefits, and their effectiveness entirely depends on your situation. So there really isn't any clear winner here, since each one has its specific use case and can offer an advantage or disadvantage based on how it's implemented. That pretty much wraps it up for this video, but I've made videos diving deeper into stock market indices and mutual funds. So if you'd like to see those videos, make sure you click or tap the screen right up here, and as always, make sure you click on my face right here to subscribe for more weekly videos. That's been it. I'll see you in the next one. Peace.